Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the bullish trusting line candlestick pattern, a powerful signal that indicates a shift in market momentum. This pattern can be a game changer in identifying potential uptrends and enhance your trading strategy. So stick around until the end of this video to learn how to spot this pattern, understand its significance in the market, and apply it effectively in your trading. Let's get started on unlocking the potential of this valuable trading tool. Now let's break down this pattern. The bullish trusting pattern is a two candlestick pattern that signals a potential reversal in a downtrend. It begins with a strong bearish candle. This pattern begins with a strong bearish candle, followed by a second candle that opens lower but manages to close above the midpoint of the first candle. It closes above the midpoint of this first bearish candle we can see here. This formation suggests that sellers are losing momentum and buyers are stepping in to push price higher. Characteristics of this strategy is, first of all, the first candle is long and bearish, as we can see from my screen, showing strong selling activity, while the second candle opens below the previous candle close, as we can see, but closes above the midpoint of the first candle. This pattern typically appears during a downtrend, hinting a possible shift in market sentiment, as we can see in this chart. Understanding the market context is crucial when identifying this pattern. It should occur within a downtrend and the potential where it reflects a weakened or selling pressure and the potential of buyers taking control. Volume is also an important factor in this trading strategy, because you would want to see an increasing volume on the second candle, to confirm the interest of buyers. Now let's see how we can implement this trading strategy. First of all, I will mark out my market structure and I can see that we are in a bearish market. Price is trending to the downside in a bearish market. As you can see, we are in a bearish market, meaning we are trending to the downside. We have to start by waiting for the pattern to be complete. For the pattern to be complete, this means we have to allow the second candle above to close above the midway point of the first candle. As we can see, this second candle closed above the midway point of the first candle. We have to enter our trade when the price breaks above the high of the second candle. Once price breaks above the high of this second candle, look at our first candle. After this second candle did not break, so I did not take my trade. But once the next candle breaks above the second candle's high, I will take my trade in that area. This is how we can implement this strategy, because it shows that once it breaks above the high, it shows that buyers are willing to take control and are likely to push price higher. Let's not forget our stop loss because of risk management. We place our stop loss just below the low of the second candle. Remember, just below the low of the second candle, to protect our position. Let's not forget, it is very important to always trade with a stop loss. We have to consider setting a risk to reward of at least 1:2. This means for every dollar you risk, you aim to gain at least $2. This helps you to ensure that even if all trades are not successful, your overall strategy will remain profitable when you eventually get winning trades. It means it helps us to get winning trades, to stay profitable even if we take a series of losses. If we take a series of losses, our risk to reward will keep us on the profitable side because the winners are always larger than our losers. Now, how do we exit the trade? We identify key resistance level, previous resistance level in the market. Remember, we are trading when it is in a bearish trend. So we identify key resistance areas in the market that we can set as our potential stop loss, our potential take profit areas. These are potential areas that we can take profit from using this strategy. We also have to monitor the volume and other indicators that would help us signal weakened momentum, which could signal an exit point. We can also use indicators to find us our exit point when we notice that the market is having a reduced volume. We would want to immediately jump out of the chart. So at this place, if I took this trade at this place and I noticed that at this point in the chart price was having a lower volume, I would close my trade at this point of the chart. When I notice the volume is showing me there is a weak momentum, this signals an exit in the chart. We can look for another example to better understand this our pattern. A better example to understand this our pattern. And as we can see from the chart, this is a sustained bearish move where we saw a strong bearish candle and a bullish candle that closes after the strong bearish candle. Remember, we will not take a trade until we see a bearish candle that closes above the second candle. This is where we will decide to take our trade after we see a bullish candle closing above the second bullish candle. Remember, where our stop loss is going to be placed below the low of the second candle. Then we aim for previous support, previous resistance levels on the chart. We can aim for previous resistance level, or we can aim for a risk to reward of 1:2, 1:3, as the case may be, or we can decide to take out our profit once we notice a reduce in volume. Once we notice a reduce in volume, we take out our trade from this particular pair we are trading. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on notification bell so that you will never miss out on more trading tips and strategies. Thanks for watching and I will see you in the next video.